Let's bring in Tether and Worldwide Asset Exchange co-founder William Quigley to discuss not only this latest letter, but everything we have seen within the cryptocurrency space in the midst of this potential deal over the last couple of days. William, I think I'm just going to start right there with you. Your immediate reaction to the goings-on.
Well, obviously a giant surprise. Everyone thought that the major exchanges were not susceptible to any kind of serious meltdown. And once again, we keep going back to this, whether it's 3AC or Voyager or Celsius or Luna, it's a matter of debt. Debt is toxic with crypto. Prior to the bull run in 2021, there was very little debt in the system. And something happened in 2021, whether it be exchanges or funds or projects, they all took on lots of debt. And it just violates a basic principle of finance. You don't lever up highly volatile assets. So it's quite frustrating to me to see it once again. And yes, as CZ pointed out, it is a grave mistake to use a token you create as a form of collateral because it's too susceptible to manipulation. We also, of course, have this transparency issue in the case of FTX, where Alameda, his investment arm, and FTX, the exchange, was never really clear how the balance sheet operated between the two of them. And so, we've got a big surprise. And the markets didn't like it one bit. And of course, you've seen not just the FTX token down, 80%, but you see other tokens that SBF owned also going down a lot, like Sol off whatever, 50%. Coinbase itself, the company, off 20% the last couple of days. And so, there's still a lot of questions people want to know, and I think this will be tough to dig through.
It wasn't that long ago, I mean, really only just a couple of weeks ago, that Sam Bankman-Fried was being lauded as something of a savior within this broader industry, given some of the other companies, some of which you just mentioned, that have collapsed or come close to collapsing, that FTX was seen as essentially bailing out in recent months. To see someone like this and to see a company like this facing such a severe liquidity crunch so quickly, does it raise the risk that we are going to see a more severe contagion across the industry now?
Well, I keep saying this. It all depends on leverage. Without leverage, you're not forced to sell, right? And so, we don't have enough transparency into it. You see a lot of people, Circle, obviously Binance. Binance came out, also said, hey, we do not use debt, and we would never use the BNB token as a form of collateral. I think that's responsible. Coinbase has 3 billion or so, I think, of public debt, most of which I think it took on last year. That debt is priced at 65. So that it's priced substantially below par. By the way, I find it fascinating because that would imply you literally have credit risk there, risk that you're not going to get paid. But the Coinbase stock, the market cap is at 11 billion. So if the market cap for the common equity is at 11 billion, it's odd to me that the debt itself would be trading at below par, but it's substantially below par. And so, there's just questions, I think, what it is right now. And when Wall Street came into this market last year at big time, they really weren't in it before. I think one of the things they dragged in was their fascination with leverage.